Interest rates are double what they were a year ago. How can you get an interest rate that's possibly 3% lower than current rates? We're getting into that right now. Hey everyone, so you're looking to buy a home right now, but these higher interest rates are holding you back? Well, I'm covering exactly what you can do to beat those high interest rates so you can get into the home of your dreams and some creative but simple financing options. Real quick, my name is Chris Pacilio. I am with eXp here in San Diego. If you're looking to buy a home anywhere in the country and you want me to connect you with lenders that have these awesome programs, give me a call, text, or email, and let's talk. All right, let's get into it. Today, we're going to talk about how to save some money when buying a house with something called a buy down. So when you borrow money from a bank to buy a house, you have to pay back the money with something that's kind of annoying called interest. Well, right now, those interest rates are double what they were a year ago, and it's making it harder to afford your monthly mortgage payments. The good news is that higher interest rates have driven down home prices here and there, and when we couple this with interest rate buy downs, now that home won't cost you so much as it would a year ago. You're not paying over asking price, and a buy down is a special way to make your interest rate lower, at least for a little while. There are different types of buy downs, but we're going to talk about 3 of the most common ones. The first one is a temporary rate buy down, commonly referred to as a 3-2-1. In this scenario, typically the seller or the builder, or if you're buying new construction, will pay the fees associated with this buy down. With this type of buy down, the interest rate is lowered by 3% in the first year, 2% in the second year, and 1% in the last year. And then of course in the fourth year, it'll go to full percentage. Year 4 to 30, it will be adjusted to whatever the mortgage rate would have been today. This means your monthly mortgage payments will be lower in the beginning, but they will go up a little bit in the second, third, and fourth years. Then the remaining fixed for the rest of the term of the loan. The idea is that you can use the time to save money and then refinance your mortgage later to get a better interest rate. Or, for example, the interest rate would have been 6% today. With the 3-2-1, you would start at 3%, then you would go to 4%, then you would go to 5%, and then you would go to 6% for the rest of the loan. Everyone is expecting rates to fall over time, so it's likely you'll be able to refinance down to a lower rate, maybe in the next couple of years even. There are variations on this loan, like a 2-1 or 3-1 buy down as well. Now, the good thing about temporary buy downs, they can make your monthly mortgage payments more affordable, at least in the beginning. There are also some downsides. For example, if you're planning on living in the house for a long time, a buy down might not be the best idea because your interest rate will go up eventually. Second type of buy down is called a permanent interest rate buy down. As said, permanent, which is when the interest rate is lowered permanently for the whole life of the loan. You pay a bunch of money up front. Let's say your interest rate is 6%. You can pay a fee towards your loan and lower your interest rate down to 5%. Costs vary with this, but typically expect to pay about 1% of the purchase price towards the interest rate buy down. The third way is an adjustable rate mortgage, or ARM. Now, before you freak out, this is what people said caused the 2008 crash. Let me explain. What happened back then was anyone who could get a loan, if they could breathe, if they were alive, they could get a loan. Stated income loans were typically where people would just say, I made a certain amount of money this year, and lenders would say, okay, sounds good, and they would write up the loan. ARMs that were being made at the time had massive balloon payments at the end of the first 3 to 5 years, which is where everyone got in trouble. Where you want to look now is for a 5.52 without balloon payments. Okay, a 5.52 ARM can give you 2 to 3% lower rate than a typical fixed rate mortgage for the first 5 years. At year 5, it will adjust up by a maximum of 2%. So for example, rates are about 6% right now. You can get a 4% mortgage for the next 5 years. At year 5, it will go up to 6%. Over 10 years, you have a blended average of 5%. Again, you can refinance into a lower rate typically after the first 3 years. So for example, on a $600,000 purchase, you'd pay $2,300 in principal and interest for the first 5 years. Years 6 through 10, you would pay just under $2,900. Okay? On average, it would be $2,600 over 10 years. That's a quick rundown of 3 different ways to get an interest rate 3% lower than the current market average and how those methods can help you save money when you buy a home. The bottom line is you have to talk with a lender before being fully informed about the real estate world. It's a must. Hit me up if you want to learn more about buy downs. I can connect you with a great lender and get you the dream home that you're looking for.